I swear.
Always.
I need structure.
You don't need structure. That's what his class is about.
Bless you.
Bless you.
So I got 2 lectures to go over today, accounting and financial analysis, and then capital and resource acquisition. For the accounting and financial analysis portion, I've got a slide here, a couple slides in here at the beginning about collecting money. It's how many people in here have put a PayPal button on a website and used it? Okay, so some, but not that many. It's surprisingly easy to collect money online. All you really need to do is go to PayPal, spend 10 minutes max downloading the software, and you can just put a button on your website to be able to collect money from people. It's really quite amazing. PayPal is probably the most expensive way to collect money from people. They take a pretty hefty cut, but it's also the easiest way to do it if you don't have good credit. You don't need any credit rating whatsoever to be able to collect money from people on PayPal. Some of the other vendors like TSYS or Merchant Warehouse require that you as an individual have a certain level of credit rating in order to be able to use their services. But if you do have good credit, or you have a team of individuals for the business that have good credit, then you can pay significantly less money than you would with PayPal. I've got a little chart here that I've provided with information on the vendors. Merchant Warehouse tends to be about 2.5%. PayPal is almost 3%. So depends. The other ones vary, but can be significantly lower than 2% charge as well. Revenue and cost estimates. The basic equation is profit equals revenues minus costs. And revenues is what customers are reasonably willing to pay, and costs is every possible cost you can imagine that you might have to spend money on. One of the biggest problems with most startups, with most small businesses, and this was certainly the case with both of my businesses, is that your revenues are way too low and your expenses are way too high. It seems dumb, stupid, simple, but it happens over and over and over again. So in small business management, I highly recommend that whatever you think your revenues are going to be, you should plan on them being a fraction of that. Whatever you think your expenses are going to be, you should plan on them being a multiple of that. And if you can figure out a way to make your business survive with your revenues being a fraction of what you thought they would be, and your expenses being a multiple of what you thought you'd be, then you're going to be in pretty good shape. But it's amazing how expenses mushroom, and it's amazing how revenues evaporate that you thought you were going to have. So very, very, very important to estimate conservatively on your revenues and estimate very, very worst case scenario on your expenses. It's also important to remember that the business is going to consume almost, if not all, of its revenues. So another thing that I never had sufficient respect for when I was running my business is the fact that, yeah, the business actually is profitable and it makes money, but it makes, like $500 or $1,000 a month. I can't live on $500 or $1,000 a month. So the business is profitable, but it's not generating enough money for it actually to support you in a salary. So important to remember that a lot of small businesses just don't generate enough profit to pay you as high of a salary as you could make if you work for somebody else. And then finally, it's probably going to consume every penny that you can beg, borrow, or steal from investors, from friends and family, and so forth and so on. So make sure that you think ahead and plan for what your expenses might possibly be, because you're probably going to need to ask somebody for that money at some point. Revenue and cost estimates. What are customers reasonably willing to pay? We talked about customer vignettes a couple weeks ago. It's important to take a look at your customer vignettes, your product service vignettes, and estimate your revenues based on those things. Yes, Kevin? What's that? It's like a little summary. It's a one-page summary of things about the customer, one-page summary of things about the product. So it's important to base your estimates off of those things, and sometimes you'll recognize that you don't have enough. You don't have enough customer estimates. You don't have enough product or service estimates to actually be able to project revenues very effectively. So important to have enough of those. All the possible expenses that you may have to spend money on, variable costs like raw materials, labor, taxes, and benefits. Very important to think about what quantities you have to buy things in. It may be the fact that, we don't need very many seeds for the edible garden, but it may be the fact that you have to buy 500 at a time. You can't just buy 5. So always important with all small businesses to think about what is the quantity that you have to purchase your raw materials in. Marketing costs, so brand development, advertising, networking, including meals, expenses, and transportation. That I found a lot with both of my small businesses that the amount of money that I ended up spending on travel, on taking people out to dinner, on being at events and networking, buying drinks, it adds up really quickly. So almost any small business, you want to estimate higher than you might imagine for how much you're going to need for networking expenses. Overhead costs like office space, utilities, telecom and internet, hardware and software, product development, training and development, IT services, accounting services, legal services, etc., etc. All of those things at one time or another when I was running my businesses were issues that I had to think about, and each one of them cost money. When you add it all up, it's a lot of money. So make sure that you don't overlook any of those areas when you're making your expense estimates. And then finally, executive compensation. Once you get done and you've estimated how much revenue can realistically come in and what all your expenses are, take a look. Is there actually enough money left over to make a decent salary for yourself or not? A lot of times there's not, which doesn't mean that you shouldn't go forward with the business, but you may need a side job or a day job, as it were, to be able to pay your personal bills, even though the company is generating a profit. Some planning tools for how many people I forget how many people in here are like accounting focused in some way or another. Okay, so not too many. I'm going to do a little crash course in basic financial statements here. I've got a template that I put on Blackboard that you guys can use for cost estimates. There's also some great tools available from SCORE, which stands for the Service Corps of Retired Executives. It's basically retired executives who volunteer their time to do consulting for small businesses. They've got some great tools for doing financial planning as well. Many more than I provide on my website. So I also recommend that you take a look at those. But the one I've provided here, financial statements example, there's 4 different basic financial statements. So everything about accounting, it can be boiled down into four tabs on a spreadsheet, basically. Your first tab is statement of cash flows, and the statement of cash flows is nothing else except a list of every single piece of money that comes in, every single piece of money that comes out, and a category that it belongs to. So this is an example of a bakery company that brings in, they have 3 different basic types of customers. They provide food for weddings, they provide food for birthday parties, and they provide food for sort of end of the semester, end of the school year sports parties for various sports teams at the elementary, junior high, and high school levels. So you've got a bunch of line items here entering revenues that are coming in and the dates that they came in with the category that they belong to. And then if you look down further, you'll have all these costs that are listed under credit for expenses. So same thing. They go out, like take somebody out to dinner to talk about a new client, $100 of networking in January 7th, and then got to buy all the supplies to make the cakes and the cupcakes and so forth, $500 that they spent on the tent. It's just simply a list of every single cost that you spent and categorizing them into categories. So once you have that big long list of every single piece of money that came in and every piece of money that went out, you're going to summarize those into what's called the income statement. So if you notice here in the income statement, what's that?
Oh, no, just take a list.
Oh, okay. I thought it said question instead of God bless you. If you notice here in the income statement, the formula here is adding up rows from this spreadsheet here. So basically, we're adding every row that says wedding costs is being added up in this cell right here. Every row that is in the category of birthdays is being added up right here. Every row that's in the category of sports extravagances is here. So your statement of cash flows is every single piece of money that goes in and out in a big long list. You then summarize all those into categories over the course of the year, and that goes into your revenues and expenses for your income statement. So the income statement is a statement of everything that happened in 1 year of time in the company. So you've got various revenues here coming in, so $83,000 in total revenues for the year. You've got these various costs on the cost side over the course of the year, so there were $77,000 in costs, which means there was a $6,000 profit for the company at the end of the year. After that, you've got a certain amount of interest expense. So the interest expense all depends on how much debt you have. It's not uncommon for a lot of small businesses to basically run up credit cards to pay for things. So that's what I did on both my companies. Kevin, yes?
Why is financing debt more profitable?
What's that?
Why is financing debt more profitable?
Financing debt is not necessarily more profitable. The reason a lot of people use debt instead of
Circumstances, is it profitable?
yeah, sure. It's the thing you have to consider is how much interest are you paying on the debt versus how much ownership of the company are you giving up if you take in equity. So
Not equity. When is financing profitable?
What's that?
Financing profit.
Well, it's not. It's neither profitable nor unprofitable per se. It's just a question of how much money your company's bringing in and whether you can afford to pay the interest on the debt.
Is the interest finance a liability?
Yeah, it is, but
When is debt financing profitable?
I
Um,
think, for example, like, let's just say you have an order to place and you've already sold everything that you've ordered. You can put it on debt, sell the product or merchandise, and get back like under your return, and you pay the debt off, and you make profit. That's when it's profitable, I
Yeah.
think.
so does that
Yeah.
sort of answer your question? Okay. So you've got your interest expense, you've got taxes that you have to pay on whatever's left over after your interest expense, and then usually you want to plan on at least two items below the line: inventory shrinkage and depreciation or amortization. Inventory shrinkage just basically means that things get damaged, things get lost. If you have a bakery company like this, if you cook 20 cupcakes and you are only able to sell 18 of them, you can't just keep the 2 cupcakes left over forever. They're going to go stale, so you have to throw them away. So you've got shrinkage of your inventory. And then depreciation just simply means if I buy a laptop or a desk or whatever today, by 2 years from now or 5 years from now, it's not going to be worth anything anymore. I'm going to have to buy a new one. So each year you're taking a certain amount of value of the asset that you own out because you're using it and it's losing its value. So once you've put all of those income statement numbers together, those then get added up into a balance sheet. And a balance sheet is basically a snapshot of how much money the company has, how many debts it has, and what the profit for the owners of the company is at a certain period, at a certain date in time. It's usually December 31st, or sometimes people will have June 30th as the end of their fiscal year, but it's as opposed to a summary of everything that happened in 1 year financially. It's how much money do you have at 11:59 p.m. on December 31st of year X. So you'll notice here all of the revenues here are being added up into the cash account, with the exception of accounts receivable. Accounts receivable are basically money that people owe you but that you haven't received yet. There's various short-term assets in the case of a bakery, like the supplies that they own, the cakes that they baked that aren't stale yet. And then you've got various long-term assets like computers and real estate and tables and chairs and things like that. You add up the value of all that stuff. You subtract from it whatever the outstanding principal is on your debt, and whatever's left over is the equity in your company. So that then rolls into a fourth financial statement, the statement of shareholder equity, which basically takes whatever this equity number here is in the balance sheet and simply divides it by the percentages that each owner of the company owns. So you can see at any given time what each of the owners of the company owns. That is basically the way accounting works in every company in the world. It's certainly the way accounting works in every company in the United States. And long story short, a lot of times in a small business, you don't necessarily have the luxury of hiring a full-time accountant. You probably have an accountant to look over your taxes at the end of the year. If it's a small enough business, you probably never have an audit. You just simply have an accountant to help with your taxes a bit at the end of the year. And the person responsible for keeping track of the accounting numbers is you. So very, very important to understand these 4 different financial statements, how they each work, and how to compile them for your small business. Another thing that is important in accounting and financial analysis is ratio analysis. So There's 4 different types of financial ratios, and the reason they're important is to be able to compare your company to other companies in the industry and see where it is that your costs or your revenues are off from where a normal company would be in that industry. Kevin, yes?
Where's the ratio analysis fit into day-to-day operations?
More than anything, it's a periodic check, maybe once a year or once a quarter, to take a look at what are the ratios of your company and how do they compare to the averages of the industry.
My thinking is what product sells, what ratio to use.
I'll get to the ratios to use on the next page. So the types of ratios, I'll give you the exact formula on the next page, but there's 4 different basic types of financial ratios. There's profitability measures, which tell you a lot about a company's business model in addition to just the number of what the profit is. Liquidity measures, which basically tell you the company's ability to pay its bills. Leverage measures, which basically tell you about the actual hard value of the company versus how much debt it has. And then activity measures, which are basically about how money goes in and out of the company, like what the timing is of money going in and out. And like I said, it's the kind of thing that you want to check maybe once a quarter or once a year just to see how does your company compare to other companies in your industry. And in places where your ratios are different than the industry, you want to try and improve those numbers for your own company. So important ratios, gross and operating profit margin. So gross profit margin is your sales minus your cost of goods sold divided by your sales. Your operating profit margin is sales basically minus all of your operating expenses, not just your variable costs. So gross is sales minus variable costs over sales, and operating profit margin is sales minus variable and fixed costs divided by sales. Those are the 2 standard measures that you use for profitability. Current ratio is your current assets divided by your current liabilities, which basically is what are all of the things that you own, whether it's an IOU for somebody, or it's cash in the bank, or it's the assets, the tables and chairs and computers and stuff that you own, all the things you own versus all the things you owe to somebody else. And you divide all the things you own by all the things you owe, and that gets you your current ratio. It's a little bit more complicated than that because current assets are assets that can be turned into cash within 1 year, and current liabilities are things that you have to pay for within 1 year. But at a big picture level, philosophically, this is basically talking about all the stuff you own versus all the stuff you owe. And you want the stuff you own to be more than what you owe. Long-term debt to equity ratio is the normal ratio I use for leverage, which is basically the total amount of your long-term debt divided by the total amount of what the company is worth after you take away what the actual profit or equity of the company is worth for the owners. And then finally, average collection period is accounts receivable divided by the formula total sales over 365, and that basically tells you how many days does it take excuse me, how many days does it take for you to collect your IOUs? Kevin, yes.
What are ways to improve the collection period?
What's that?
What are ways to improve the collection period?
Call and harass your customers basically and get them to pay sooner.
Yeah, that's basically it.
Huh?
That's basically it.
Pretty much.
Collections.
Yeah, I mean, it's mostly, I think, first of all, it's requesting as much up front as possible, so not giving your customers financing terms, and then for whatever financing terms you do have to give them, it's just a question of harassing people. It's not a very fun thing to do. I've also got a bunch more ratios, more than you would ever want to use in these 2 links here, so BB&T and demonstrating value. All kinds of other ratios that you can calculate for for a company. So current ratio is the one I showed you. There's also a quick ratio, an absolute liquidity ratio, da-da-da-da-da-da-da. Yes?
Does credit ever cost the company? Does credit ever cost the company?
Sure. It costs whatever the interest rate is.
There's an interest?
Yeah. So, my credit cards, for example, usually somewhere between 12 and 18% interest. So,
Transaction?
yeah. So if I borrow $10,000 from a credit card, at the end of the year, I'm going to have to pay $1,800 plus the $10,000.
So there's an 18% on each transaction.
It depends on who your debt vendor is, but yeah, I mean, credit cards are usually somewhere between 15 and 18%.
What about debit?
What's that?
What about a debit charge?
Debit charges are simply taking cash that you already have out of your account. If the debit card ends up going into negative number and you start using credit, it's pretty much the same cost as your credit card. Debit card is usually just a card that allows you to take money out of a checking account. Once there's no more money in the checking account, then you can't take any more out. So that is ratio analysis, and then I've added two data sources here for you where you can find industry average financial numbers. So one of them is a hard copy book in the library. The other one, which is much easier to access, is First Research Industry Profiles. If you just go to First Research Industry Profiles, type in the name of your industry. So if we're looking at the Condors, for example, we just type in the word sports, professional sports teams and organizations. You can open up this report, scroll down to the bottom of the report, and it'll have a bunch of industry average financial numbers starting right here. So that is the basic lecture on accounting and financial analysis. There's a webinar that goes along with this. But it's about 20 minutes long, and I think it'll be better if you guys watch the webinar outside of class than playing it all for you right now. So homework, as it were, between now and Thursday is to go into Blackboard, open up the webinars document, and watch two different webinars, one on navigating grant sites, the other on navigating angel investor sites. So I'm going to talk a little bit more about these two right now, but the last couple lectures I actually played the webinar for you in class, and I think this time I'm going to ask you guys to watch that webinar at home between now and Thursday. So. Yeah, the last two on the list I want you to watch between now and Thursday. So that is my lecture on accounting and financial analysis. Let's move on to capital and resource acquisition, and then that'll be the ball game for today. So big picture level, accounting and financial analysis is about keeping track of the financial numbers in your company, like summarizing it, reporting it. Investor and resource acquisition is about where are you going to find the money to pay for all those expenses that you have until such time as you have enough revenues coming in to pay for them all. So there's four basic sources of three main sources of capital. The way most companies get started is by using credit card debt and lines of credit. So access to that is largely dependent on your personal financial situation and your credit rating. Once your company is up and running and can demonstrate that it has customers and it has a track record of revenues, it's a lot easier to get bank debt, and that's basically based on the assets of your business, your financial statements that we just talked about, those 4 financial statements that you prepare for the company, and then certain elements of your business plan. Submitting all those to the bank is what you need to do in order to get bank debt. And then finally, an area that I didn't used to focus on as much as I do these days, grant money. There's a lot of grant money out there, and the nice thing about grants is that it's basically free money. Equity, you have to give up part of the ownership of your company in order to have equity financing. Debt, you have to pay interest on. Grants, they just give you the money and you don't have to pay it back. So that's the wonderful thing about government grants. The challenge with grants, hang on one second, Kevin. The challenge about grants is that there's a whole bunch of paperwork you have to fill out. Usually there's amazingly complex eligibility criteria, so you usually have to partner with other organizations in order to be able to get them, and there's a lot of bureaucracy. Yes?
When are businesses eligible for
Bank, well, grants come from government agencies. Loans come from banks, but when are they eligible for loans? Basically, I'd say after at least a year of operations. Huh?
Are there such things as business grants?
Yeah. But they come from the government and from non-for-profits, not from banks. Yeah. So another source of bringing in capital, which is sort of a combination of the things that I talked about in the first page, is called crowdfunding. We're working on crowdfunding right now for the Potty Boss campaign. We may get into a little bit of crowdfunding for the Edible Garden eventually, but crowdfunding is basically getting very small amounts of money from thousands and thousands of people by using the internet. So the way crowdfunding originally worked was basically like a guerrilla marketing campaign where you're selling your normal mix of products, but you're selling them at marked up prices, and you're using the difference in profit as an investment in your business. And a couple things that are important for success in crowdfunding. You got to have a project plan, and you got to have your fulfillment and your outreach planned very well before you ever start the campaign, or it's not going to go well. And if you can manage to get a crowdfunding campaign up to 20% of whatever its goal was, that's when things start to go viral. So if you can make it up to 20% based on people you know off the top of your head, the other 80% starts to build after that. And I've listed a couple of good information sources here: CrowdCrux, Entrepreneur.com magazine's crowdfunding site, and then we've got some nice webinars from our Small Business Development Center on crowdfunding as well. It's something that didn't used to exist, and it's a very, very useful new way of raising money for a company. There's 3 main crowdfunding sites that a lot of people use: Kickstarter, GoFundMe, and Indiegogo. There's also a brand new type of crowdfunding called equity crowdfunding, where basically instead of selling your products, you're actually getting investments from people in exchange for part ownership in your company. I've listed three of the leaders in that area here: Angel.co, Early Shares, and Grow VC. And these are just 3 of dozens and dozens in each of these categories. So if you click on the other link, you'll notice that I think top 10 crowdfunding sites, and then there's a bunch of other ones listed down here that didn't make the cut. So there's probably 20 or 30 different major crowdfunding sites that you can use, and the same thing for equity crowdfunding. So those are all listed for you in my PowerPoint here. Very important things about crowdfunding, first of all, is putting together an attractive web page. The entire crowdfunding campaign runs through a central web page. So having attractive materials, being able to tell your story effectively on that crowdfunding page is critical. And then having the project plan well set up. I've given an example here of of an initial plan that we actually made for the Edible Garden crowdfunding campaign a year ago. And you'll see here, it starts with making sure all your materials are prepared, doing some initial outreach. You've got to have your fulfillment done before you ever do more than initial outreach. And then basically all the rest of this is different platforms that you're reaching out to people on to contact them, to tell your story, and hopefully to get them to donate money. Traditional equity investors. So equity investment is basically you get a certain amount of money. You don't have to pay it back, but you have to give up % ownership in your company. So the traditional sources of that are individuals. So your friends and family, usually people that have personal savings of over $10,000. If you don't have at least 10 grand in the bank, you're not going to be able to peel off a grand or two to give to somebody in your family as an investment. So the higher the personal savings, the less risky it is, obviously. So the relatives, friends, and family that you know that have high net worth are usually your best bet for your initial investments in your company. Another way is partners or in-kind resource providers. So, in some ways, Shout right now is you're raising money, but you're also raising donations of beds and things like that. So if you didn't get the beds given in kind, you'd have to buy them. So in addition to actually getting investments, there's also the opportunity for a partner company to give you either resources or to invest in you, just like an individual would. And then you've got venture capital and angel investors. And the punchline here is that angel investment and venture capital investment almost never happens, especially for lifestyle businesses that are kind of small, that is basically like a one-person show. You almost never, ever get that investment money for a small lifestyle business. However, you can't win if you don't play. So it's very important to have good, organized materials and keep them in circulation with investors, because you never know when you might find the right investor. But if you're expecting to go to a venture capital company and the first one you go to gives you money, it doesn't work that way. You may go through dozens and dozens and dozens of angel investors and venture capital companies before you ever have one that says something other than no. So basically, what you need to present to equity investors is an executive summary, no more than a page or two long, with the rest of the elements of the business plan, like description of your customers, your financials, description of your management team, etc. All of those things need to be available, but really what you want to give the investors is a 1 or 2 page overview of your company. That's it. Couple other slides here. I like to talk about harvest options versus exit options. A harvest option happens when there's nobody else that would want to buy your company. So as you're starting to work on a small business, if you find other people that are excited about it, other people that want to be a part of it, you want to start thinking more about exit strategies, things that other people besides you could do, and eventually you get paid to give the company to someone else. If you're constantly struggling to try and do things and nobody seems to care about the business except you, then it's probably going to end up being a hobby rather than a business. But that's okay. Hobbies can make you some nice side income, and they can certainly be a lot of fun in life. But the real question of harvest versus exit is, are there other people that are excited about this business? If there are, there's probably the opportunity to sell it eventually and have other people run it besides you. If you're the only one that's ever excited about it, then probably you're talking about a long-term hobby that makes you some money on the side. Couple information sources here for capital acquisition. just networking with friends and family. LinkedIn is great for this. I've got a link here that I provided for the Small Business Administration. It's got a lot of good information on how to get small business loans. And then Google, whether you're looking at grant associations or investor associations, there's all kinds of good information that you can get on Google about your capital acquisition targets. And then finally here, I've listed 5 different sources for grants. In particular, grants.gov. This is all money that's given out by the federal government. So grants.gov is your source for all federal government grants. California.gov, with the rest of this, is the state version of that, so money that the state gives away. And then GrantWatch is actually a website that tells you about nonprofits and foundations and stuff that are giving away money. So there's a webinar specifically on how to navigate these sites that, like I said before, I want you guys to watch between now and Thursday. And it explains a lot more how to navigate those. And then finally, last page here is 3 different information sources for investors: Tech Coast Angels, Angel Capital Association, and Funding Post. Tech Coast Angels is a particular angel investment group that's here in California. It's based in the LA area. And the thing that I really like about this site is they describe exactly sort of a list of requirements that you have to fulfill in order to be eligible for angel investment. And a lot of times angel investors are like this secret society, and you never know exactly what it is that you need to show them in order to get investment. Tech Coast Angels does a great job of explicitly saying this is what your business needs to look like if you expect to get money from us. So great example of exactly what you need to do to get angel investment money. Angel Capital Association is basically a directory of all of the angel investment groups all over the country. So it's like a phone book of angel investors. And then finally, Funding Post is sort of like Facebook for getting funding. So you put together a little profile for your company. It's a social media network, but instead of sharing pictures about your life, you're connecting with investors who might be interested in investing in your company. So those are the 3 main sites that are important for equity investment. That is pretty much the end of my slides. And if you guys are not upset, I think we could all go home a little bit early today. Lauren, yes?
What is pro forma?
Pro forma means into the future.
Okay.
So pro forma means what am I projecting? For the PDP, yeah. Pro forma means I want you to think about how much money you have to save in the future to reach your financial goals.
Okay.
And how much extra money you're going to need to bring in because you can't save what you don't have.
Yeah. Okay.
Yeah, otherwise, Thursday we're going to be working on projects all day again. I'll have posters and flyers for the Converse team. Yolanda will be working on please make sure you make the rest of the edits to the website. I want to take a look at it on Thursday. I will look through all the edits to the website for Potty Boss, so we can talk on Thursday about getting started with the Tupperware parties. And then Edible Garden, all of the different assignments that I gave everybody, we're going to be sort of updating on all those, and we'll go from there. See you guys on Thursday.
For the 10 patients, also, there's
I'm listening.
career fair. I was going to the career fair on Wednesday. Next Wednesday.
Yep.
I'm going to that.
Yep.
So, what should I bring business cards, or how do you want?